Welcome to Tradiers, the Trader's Edge. Yeah, that's right. I forgot for a second. Guys, people, give me a break. I'm not young anymore. Sometimes we forget things. Tradiers, the Trader's Edge. I'm Jim Iuorio. That's Bob Iaccino. We are also 2/3 of the team at unfilteredinvestor.com, which we appreciate all the support you've given us on that. Bobby, so I just was writing notes because I'm going to be on Fox mornings with Maria tomorrow, with Maria Bartiromo. And I just was writing my notes a second ago, and I came up with this that just popped into my head, is that you can say all you want that the stock market was trading on its heels for the last 3 weeks because oil was going up and it painted the Fed into a corner and the Fed didn't know what to do. And now that impetus is kind of going away, that doesn't mean the stock market bounces back to where it was, because sometimes that you can't unring the bell and people have to reassess risk after they've had a shot to the nards event. Do you agree this might not be over yet, correct?
Yeah, I think it's definitely not over. I'll give you a couple of things. So you can look at the NASDAQ or the Qs. We're now in our fourth full day below the 200-day moving average. That's today. We didn't get back above it. We had a just about, I'm going to measure right now as I'm speaking as if I did it earlier, 8.93% move lower on the lows. So not quite a technical correction, but it would be enough because remember, people started saying corrections were 8 to 10% after you and I learned they were 10%. I'm actually it was 9.18% to the lows. So we could still get a little bit of downside. I think that when you have a supply side stress, like we clearly had, there was clearly less crude oil coming into the markets, and not just crude oil alone, distillates as well, some natural gas. That has to actually work its way back up to normal levels.
Okay, and then you think the stock market will be fine, so you're discounting my thesis? Okay, interesting. Okay, so we are, I say this all the time, I'm going to say it again. You guys can think Bobby and I are full shit. We sometimes think it ourselves, but you cannot not argue with the fact that we somehow get fabulous guests to agree to come on. We're bringing on one of our friends, one of our favorites, the co-founder of Market Scholars, David Settle. Bobby.
So I was talking to Jim, David, and then I talked to you without Jim knowing. And I said, well, next time we talk to David, I got a basketball question for both of you. By the way, a friend of mine the other day asked me when March Madness was. I said, it's in freaking March.
It's in April.
Yeah, it's in April. But I was watching a couple of the games, mostly Illinois games, because one of my nieces went there. Jimmy went there. Another one of my nieces is going there next year. And
I noticed after a couple of seasons of like Illinois having a basketball team again, all the stuff gets put up in the background there.
Right? I don't know. It would have been up there either way. I've never missed a football game or a basketball game within reason, even back when they stunk. So stop that, Bobby. Go on.
All right. So I'm combining this thing that I was watching college basketball, which I don't watch all the time. And then I actually have started to see all these videos of the traveling in the NBA, right? And I watched an NBA game. I saw 4 traveling calls I would have made, not having as much knowledge as the two of you do as basketball players and coaches. Why do they let them travel like this? And is that Euro step an actual travel? That's my question.
David, you take it first.
Yeah, the Euro step's not a travel. It's just too big. Like people are conditioned for timing on those steps, and so when you throw off timing and they're longer steps than normal, it looks like a travel too, just like the untrained eye is just watching from the stands. That's a Euro step, but there is plenty of traveling. But nobody wants to see, like, nobody's paying hundreds and hundreds of dollars to sit courtside to watch you call a travel on Giannis onto the Campupo or whatever his name is.
Okay, but hold it.
David. I saw a travel and a double dribble by a guy.
Yes.
The guy dribbled, stopped, got hold of the ball, dribbled again, and then traveled. No call.
David, let me ask you this. In college basketball, here's what irritates the shit out of me. I understand the pro game is about making money. The college game is not supposed to be as much about making money. What bothers me is a guard taking a pass on the perimeter. And instead of just planting a foot and turning and and establishing a pivot foot, they take like 4 steps to stop themselves, and nobody gives a shit. That drives me crazy. Does it drive you crazy or no?
Oh yeah, for sure. I mean, I was talking to my son. I have a senior who played, and I've coached all growing up, and the High Point game, they beat Wisconsin, I believe.
Yep.
With a kid who didn't make a single 2-point shot all year long, only took 4 of them, didn't make any of the 4. And he finally makes his first 2-point basket on a breakaway layup, but he traveled.
Yes, but they don't call it. Yes.
They would have called that on my 8th grade team.
Yeah.
Something pretty cool in that High Point game. The team chanted USA, or the crowd chanted USA, USA while they were singing the national anthem. And then High Point posted it on their Facebook page.
I love
that.
that.
That was pretty cool.
I love that. So David, I started, I've coached for 25, 30 years, but this year, the first year I coached high school varsity girls basketball. My niece is a head coach now, I was her assistant. And it was so funny at the beginning of the year. She's like, our starting lineup, our average rotation is like this much more than a sophomore playing in literally the toughest conference in the state of Illinois. The team that finished 5th in our conference finished 4th in the state tournament.
Wow.
So to be clear, so at the beginning of that year, I said, we have no height, we have no experience, we have no real discernible basketball skills yet. Girls, you're learning them. I know that you're good, better now than you were then. But I said, we are going to be tough. We're going to be physical, and we're going to scare the shit out of everybody. And guess what happened? We did. We lost a lot of games, but every coach was like, wow, your team comes at it hard. And I was like, yes, we do. So it was really fun. Yeah. How'd your season go? Good?
Usually the most physical team wins.
I agree. Yeah. Your season go good?
Yeah. We had a pretty decent year. Yeah, decent year this year. Not as good as last year, but a pretty decent year.
Okay. So let's go right to markets then. You heard what I said before when you were waiting in the green room is that I don't think it's over yet. Bobby thinks as soon as oil can get right, then the stock market correction is over. And I assume he's got, I know he has levels for that. I looked at 6,800, seemed like an important level to settle over. What is your general feel right now for the overall market?
Yeah, we've had a pullback. We've had a pullback down to that 200-day moving average. I heard Bob talking about that there with the NASDAQ trading below it. The S&P's been below it for 5 days. Now it's just been kind of hovering there. So my definition of a correction is a little different than like the 10% number that gets thrown out there. So my definition of a correction is an extended run below the 200-day moving average, right? That's no matter what percentage it takes to get there. Because sometimes we talk about corrections in terms of like 10% declines or whatever the number is, or bear markets, 20% declines. But we don't talk about the rallies that go into those pullbacks, right? Some rallies are very significant and get significantly above these average values because the market moves so fast. And we can return back to the mean quickly and just be nothing but that, just returning back to the mean. So a full-on correction, an extended run below the 200-day moving average, where most of the losses of that correction occur below the 200-day moving average. Like that to me is like something that takes multiple months to play out, and then an additional multiple months to get back up to new highs. So the issue is whether a pullback itself turn like we have right now, 5% plus or minus, right? It's like 6 point something or 7% on the S&P, depending upon whether you go high to low or close to close. So we're there, plus or minus a point or two. We're to the 200-day. The question is, do we bounce off of this or break out? And in my analysis that I've done, there are a lot of signs that would suggest that this is the kind of pullback that turns into a correction. And again, an extended run below the 200-day moving average. But I think the reason for that is because we've been sideways for like 6 months.
Right.
Unbelievably sideways, like historically flat for like 20-week period. And that's made the market look more bearish than it actually is.
Okay, so let me just, Bobby, before you jump in, is that because I had surmised since October is that 7,000 level was the put up or shut up level. We had priced in a crap ton of fundamental good news, tax cuts, regulatory reform, reshoring investment. And if Donald Trump says $1 million trillion coming back, we can assume he means maybe 6 or 7 trillion, which is a lot of trillion still based on my calculator. So we priced that all in, and it's like something new has got to push us to that high. That's kind of what you're thinking as well, right?
Yeah. I mean, we've been stuck at that level and like lit so flat And now we are at the low end of that because we're sitting right at the last pullback we had back in last November. We're sitting pretty much right at that low point right now. So that's our level that if we hold, great. If we don't hold, there is not, we moved so fast off that low point last year that there's not a whole lot of support down below here, down below the 200-day moving average. It could turn ugly quickly. It's just a matter of whether we actually break that. And so the question is, do we have something, like you said, we didn't have anything to break us through 7,000. Do we have anything to break us through that low point that's other than this supply shock, right?
Okay, so Luis, forget what I typed into the chat. Remo, I'm going to get to your Leon Cooperman comment. I'll get to that next. But what you said intrigues me a lot. So the last time that we got below the 200-day moving average for any significant point, and just for the record, I'm looking at a continuous ES futures contract. Okay, but it's going to be pretty much the same in the SPX or the SPY. It took about a 6.75% move to get below it. Mm-hmm. Then we spent 45 bars below it, or 64 calendar days, 45 daily bars. What part of that is the correction? And since the move to the lows was about 20 some odd percent, I think I'm looking at.
When was this again, Bobby? I missed when you said that. What are you talking about back in April, like Liberation Day shit?
This was February 19th. Yeah, it's basically April. So it took us from February 19th until about March 6th to get through the 200. That was March a move at 6 and 3. What's that?
Yeah, March 13th is where we bottomed out on that run.
Perfect. So that was a 6.75% move. The ultimate move was about 21.5% to the low. Yeah. And we were down there for 45 bars or 64 days. Okay. Yeah. Obviously got weekends and days off in there. What part of that is the correction to you? Do you just like not look at bear markets at all? Say, I don't care about bear markets because eventually stocks go up?
Yeah, well, no, I do care about bear markets. They just don't occur very often, right? I mean, to me,
a bear market. I mean you don't care about them. I mean you don't use the term all that often.
Yeah, no. For me, a bear market is an extended run below the 200-week moving average, right? That takes you, like, again, that we just don't get very often, right? We don't, when we're in a secular bull market like we have been in, we don't get like runs below the 200-week moving average.
You have to go back to COVID for the last time.
Yeah. And it was like barely, and we only lasted like a week. And then we were right back up above it, right? And so in this particular example here in February of 25, we bottomed out in March. So usually a pullback that leads into a correction generally makes it a little bit beyond the 5% mark, like closer to the 10% mark. And usually gets maybe even a little bit below the 200-day, like it did here in March, early March, mid-March. And then it rallies. You notice how it rallied back up by the end of March, back up towards the 200-day, even got a little bit above it for a couple of days, and got right back up to like close to the 50, but just a little bit above the 200. And then on March 26th, we broke back down, right? That break back down, that's the correction, right? That's the idea that, okay, we had the big pullback down to the 200-day. It was bigger than normal. It went a little bit beyond. And then we had the bounce, because you always bounce off of these lows. But those bounces typically, in corrections, those pullback bounces typically fail. And that one, when it gets back around the 200-day, like that one did, and then boom, that's where we had, after that is where you have the biggest losses, fastest losses. Even so COVID move did that.
This is super interesting to me, because then that means, by your view, essentially bear markets are aligned with some sort of crisis. So looking at the 200, first of all, we're 21.5% away from the 200-week. So if anybody's listening to this and going, okay, I'm going to watch the 200-week, you should all know that's a big move to get there. Yeah. And I'm not disagreeing with David at all. I'm just trying to like understand this, because I really, really like this.
Yeah, in 2007 or 2008, when we did break,
that's the last time we spent any real time below the 200-week. Prior to that is 2001.
Yeah. So in 2008, when we did break the 200-week and we bounced and failed and then fell back down, we fell like 45% from the 200-week to the low. That's great.
Wow. I like this a lot.
The biggest losses occur below those levels. And it generally takes like corrections generally take about a 20% drop, plus or minus. So like a correction down to the 200-week moving average, which you say is about 21%, that would be very, very normal. And it would, like, that's a very normal number. And we would bounce off of that, get back up to new highs within a few months. If it's a normal correction that doesn't fail in its bounce and then break back down below that 200-week.
I have a question.
I mean, just for the record, that's 179 trading weeks below the 200 that happened in the great financial crisis.
Jeez, that was awful.
Below the 200 week.
Yeah.
Go ahead, Jim.
What's so funny, just what you just said right there, and I do have a question, but like I have like half of my friends are retiring right now. And I just think I don't know how, they're all different jobs than what we are. And I wonder if they know the wealth effect of the assets they hold compared to nobody could retire from 2008 to 2015, but that's beside the point. My question to you is this, is that, Bobby, I'm going to ask you first. You look at a longer term chart of the ES every day. Is there a level, and I kind of eyeballed it, and I don't know what yours is. I said maybe a settlement above 68.25, which I think is, it's obviously far away from now. Maybe that gets me back longer term neutral on it, because right now I still, I don't think that it's convincing me yet. What do you think?
To me, it's 68.0529.
Okay, good, because that's the level I came up with. I just rounded it up to 68.25.
Yeah, and so that takes me above all the major daily moving averages, and that starts to turn my rotation zone back positive. So that's the exact level. Level will obviously change. Yeah. So,
of course, David, what do you think?
Yeah, I'm looking at. That ultimately, you can start to build small, right, and trade small, anticipating a rally, and then build as you get confirmation. I look at last week's early week rally, right, where we thought we were coming off the low point last week, and we had a really good Sunday night and Monday morning, and then obviously we didn't hold it on Monday or Tuesday. But if you look at the that level right around 67.80, where we finished on the 17th there, if we were to close above that, then now we've got higher levels, like higher highs, even though we're coming off a lower low. But if we were to close above that, you're well back above the 200-day at that point. And again, you can start building. You can add more later as you break the 50, and the 50 might actually be close to that by the time we got there. But that's kind of the level I would feel more confident about us rallying. Because again, if we don't go below the 200-day and stay there, correction, right? Then pullbacks generally bounce back up within a few weeks, right back up to new highs. It doesn't take very long to get back up to new highs here. I mean, you're just right back up there before you know it. Right.
So again, and I'm going to ask you a question too, and it's going to be about what do you think looks good, if anything looks good right now. But I will say, everyone who watches this and anyone who subscribes on unfilteredinvestor.com know, like, starting about 2 months ago, I carried 3 times the normal hedges I do just because of that 7,000 level. I've been getting out of them even as they've exploded to like 4 times, just because based on the value of it. But I'm starting to get out of them, but I don't really know what to do. So I'm hoping this show I can figure out some direction too. So what do you look at, David, that looks pretty good right now? Is there a chart that you like from a positive standpoint?
I mean, I like technology stocks. I like the fact that they're oversold and they're beaten up. I like that fact. I mean, that's, if the markets are going to be bullish, they're the ones that need the juice to go to pull it up higher. They're the biggest sector in the markets. If semiconductors and those other kind of stocks are not leading the way higher to 7,000. I mean, for us to get above 7,000, we're not going to do it with industrials or materials. If we're going to get above 7,000 and stay there, then we need technology. And I love the fact that finally, like, technology is like oversold, and not just oversold on an absolute basis, but oversold relative to like energy, for example. It's extremely oversold relative to energy. So there's a really good kind of pair trade there, I think. As a good
like that a lot. Yeah, Bobby.
I want to go to Luis, the comment from Remo. And by the way, Remo, I'm setting up the chart that you put up on Twitter because I want to put it up. But Remo says Leon Cooperman was just with Liz Clayman. Market is expensive, and he sees a recession by year end. You guys agree, disagree, or don't have any interest in that call?
I have interest in it. I don't think David does. David likes charts, right? I have interest in it. I think a recession by year end. We haven't had a recession in some time. If you, but you discount when they changed the rules back in the Biden administration. But I don't. It's not that important to me because a recession then gets met with excessive liquidity, which could actually in the end be good for stocks. So I'm interested in it just from curiosity and to see going into the midterms if they're going to keep the momentum on the from the Republican side, which is interesting to me more than, again, I don't really have a horse in the race, as most of you know. David, do you have anything to add to that? No, right?
Yeah. I tweeted out in November, or late October or November. I tweeted out that whoever wins this presidency, whoever, at the time it was a question, right? Whoever wins the presidency is going to inherit the most overvalued market that a president has ever inherited in a 4-year term. Like just barely higher than Bush inherited. If you look at, depending upon the valuation, of course, but I look at the CAPE valuation, the long-term valuation, which was, again, just a smidgen higher than what Bush had in 2001 when he was inaugurated, right? Early 2001. And so, I said, I tweeted out that like whoever gets this, like they're going to be facing an uphill battle. I mean, Bush inherited that market. We had 2 bear markets in less than 10 years. Right, the end of the secular bull that started in 1982 and ended in 2000. That was an 18-year-long secular bull cycle. Ended as he inherited, as he was inaugurated. Essentially, we were in correction mode that ultimately turned into the first bear market, and then another one, with the Great Financial Crisis. So a secular bear cycle, similar again to this bear cycle we had 65 to 82, right, where we just went 15 years with nothing. And that's what we had from 2000 essentially to 2013. We had 13 years of nothing, just flat market there. And then we took off, right? And now we are 17 years off of that 2009 low. We've had multiple runs down to that 200-week moving average since, multiple, right? So corrections, and we still haven't broken that. So I do think that we are very mature in this secular cycle. I think we are closer to the end of it than we are the beginning of it, far closer. So whether that ends up being this year or not, I do see this big pulling forward of CapEx spending right into AI and infrastructure and all that. It's very similar to what we've seen before. This, you just pull that forward and then once you've done it and you're not getting the returns on it and there's no more CapEx going forward because you pulled it all forward, then what happens to the markets? And is that 2026? Like, I doubt it's that soon, but I would say there's probably more a year or two from that.
Bobby?
Luis, can you put up this chart? Because Remo went out of his way to tweet it out to us. So I just wanted to put it up and look at it. So this is obviously Spider, right? Spider ETF, S&P. And he's got Obama 2 terms, plus 184% gain with 3 declines, minus 17%, minus 21%, minus 17%. I really think, by the way, he's using presidents more as lines of demarcation than fault or credit. Yeah. Trump first term, 63% gain with 2 declines, 21%, 36%. Biden first term, 63% gain, 2 declines, 27%, and 10%. Trump second term, down 21%, then rallied to new highs. Mm-hmm. I'm looking at that and I'm saying what you say, David, about bull markets and corrections kind of makes sense.
Yeah, we've had 7. You can see them all on that chart. 2010, 2011, 2015, 16, 4th quarter, 2018, COVID, 2020, 2022. And then this year, or last year, 2025. That's it.
So based on that, based on this, I had a friend who is a wealth manager, and after the Iran conflict, I guess it's a war, began, he called me up and he's like, what am I supposed to tell these people? And I'm like, what do you mean? He goes, well, the same people who wanted to get out when Trump announced the tariffs in the beginning of his term, they wanted to be out. They wanted to be 100% cash. I talked some of them out of it. A couple of them went to cash anyway and regretted it, are now calling and saying they want to be out of the markets, given that there's a war and Trump's doing it to the markets again, and he's going to keep doing it and he's going to ruin the economy. I mean, I gave them the advice I had in my head. What advice would you give these people? Again, they're longer term investors.
Yeah. I mean, it's like, we saw multiple tariff tantrums, I guess you could call them. 2025, 2018 were multiple tariff tantrums. The market recovered from COVID like you would not believe. The rally off of that, the rally from that low point back up to new highs treated the COVID. I mean, how many people called that a bear market? And yet we were back up to new highs within months. That's not what bear markets do. And so it's like, I understand. Like, I understand completely. I mean, I feel like I did in, 2006, 2007. We're very like close, but there's what I don't see now is what you usually start to see towards the end of secular cycles to where you're like, this is concerning. You don't see like fraud or full on like breakdown in any kind of industry. You see a little bit like you've heard like private credit. You've also heard commercial real estate. Like you've seen little inklings of things there, but no like large scale fraud yet, and no like full on like the industry is like down and broken, like you saw with mortgages before we had the 2008. So that's until you see something like that. I mean, nobody like is scared about the markets at their tops.
Okay, so that brings me to a question. Oh, you know what? Let's do a pause for a commercial real quick. Luis, can you put the banner up? But I have a good question after this. You guys, we ask a favor at this part of the show. Could you guys please try Tradier Pro for 3 months for free? All you have to do is scan the QR code. We talk to options traders who've traded for decades and some who've traded for just days, and they all say the same thing about Tradier Pro. It is the gold standard in options trading platforms. Please give it a try. Just as a favor to us, it is no cost to you for 3 months for free. Thank you guys for considering. And now back to the show. Okay, so David, you just said something that really piqued my interest, and I think it's incredibly important. Bear markets begin, and I've argued this forever. Bear markets begin and are born of complacency and lack of respect for risk. Okay, so we have a couple things that are interfering with that signal, in my opinion. One is the absolute explosion, proliferation of options, mostly the 0 days to expiration options, which I believe could be something that causes more volatility in the short term, but ends up maybe making the hedge stronger to grow longer long term. It might be making for a more durable market. We have a headline bomb as a president, Donald Trump, who could shake anytime people think there's no risk. You could get a curveball from him that knocks the crap out of you. Third, volatility, you can see it. VIX is trading a lot higher than it normally does this year. When you put when you put those things in a bag, does that make you think that the bull market has a little more room to run? I mean, maybe people are paying up for options hedges, et cetera. Do you like it?
Yeah, I like where the VIX is at. Honestly, I like where the VIX is at. It hit 30 briefly, but it hit 30. The volatility, the VVIX, right, has been elevated too in the 120s, 130s. Like both those things tell me that there's juice, right? I call that juice. Like the market needs juice to get going again to the upside. You can't just have like a little 1% decline and expect a boom 10% pop off of a 1% decline. You need juice. You need some money shifting hands, and I think the volatility index, the VIX, is up high enough that we have enough juice, enough potential energy that we can convert into a nice rally. I honestly don't think we're done yet. I'm looking for like a double-digit type rally here mid-year. We're seasonally in the most bullish time of year.
Bobby, do you like that analysis that I just gave? What are your thoughts on that from a fundamental standpoint?
Actually, I was very focused, and I'm not sure why. You've talked a lot, Jimmy, about that zero DTE thing, making a more robust market long term. I've thought about that a lot, and I had breakfast with Lex. Say his full name for me, Jimmy.
Kevin Lutheringhausen.
Yeah, he's one of the. Well, he's an important guy, and he. We talked about the zero DTEs a lot, and we talked about the risk of Trump and things like that. I think I am a massive proponent, like even a disciple of your theory on that.
Oh, good. I thought you were coming at me on that. I was getting ready to defend it.
I was like, you're out of your mind. That's just ridiculous. Another one of your harebrained. Wait, maybe that's right. So I'm really focused on that because I think that's a very important thing. we used to have 0 DTEs, right? It was just the day or the day before expiration.
Right.
But we had those.
Yeah.
You traded them. You had
Sure.
clients. I had clients that would come out and say, buy me 3,000 at cab just for the hell of it,
Yeah.
So they traded those things all the time. And I think you're right. I think the average person who trades options is starting to understand that there's another value for them through that excess volatility.
That's interesting. I think so too. So let's switch. You said technology, which I think is interesting as well. By the way, do you mostly talk about the indexes in your letter and with your clients, or do you boil it down to individual names as well?
Yeah, we'll boil it down to individual names too. Those are most.
Do you mind sharing with us something that you've looked at and you love the chart and you think it looks strong as hell, or do you just give them a little tidbit, a little taste? Maybe we'll get you some subscribers.
Yeah. Like I said, those I like Apple right now. I like where it's come down to. I just had a nice, good multi-month pullback here down to its 200-day moving average. I like where it's settling in. I mean, there's a good opportunity here. I don't see it breaking, unless if it does break, then the market's breaking. And if the market breaks, then we have an extended run below the 200-day moving average. And whatever would catalyze that, I don't know what it would be at that point. But that's the only thing I can see Apple breaking its 200 days, more of a broader. So I like the value there in Apple. I actually like
both you guys. I want you guys to do a quick just analysis of some too. I had some calls on my Amazon position, and I'd like. It was kind of that I was blindsided that I got called out because I didn't want to pay the capital gains. But on one side, I didn't really care that much. That's why I didn't monitor it, because I wanted to free up some capital to do some else, because I thought the Amazon chart at the time looked tired. What do you think on Amazon? Do you think that that's something you're interested in again, or no?
Amazon, that's a little different story. Like it has been staying down below that. I don't, and it doesn't look like it's flattened out, and it's got some good support down below, right around that 200 level. A nice round number, right, of acting as support when it went through its last earnings cycle. I don't like how after that sharp decline, the rebound that we've had has been very minimal. I mean, it's
that's what I thought.
Very kind of dead cat bounce-ish. Yeah. It makes it very easy to break the low point on that at the low point of that post earnings move.
Yeah,
Jimmy, Amazon for me is broken down both daily and weekly. So now, the way that I would look at it, you're looking for maybe $181 before there's value to the buy. For me, when I'm looking at something like an Amazon. So I don't like Amazon here at all. That could change, but that's, I would need a big pullback here.
If you look at that weekly chart on Amazon and you look at those bars, the candles on the weekly chart, if that were an intraday chart, like that would be a dead cat bounce.
Right.
Yeah.
And since we're talking about tech, Bobby, what I'm going to ask about as well too, my biggest single position, and it has been for years. And lately I've taken to making it an income position. I saw a lot of calls because the calls were attractive to me, is Google. And David, just so you know, people sometimes think I'm crazy, but I've gotten more converts than not. I started buying Google 7-8 years ago when I came to the realization that Google is just an arm of the U.S. government, and it's the CIA. It is true. I'll argue with anybody. Debate format, casual or formal. But anyway, what do you look at Google? What do you think?
It's obviously it's been in a decline. It's still above its 200-day moving average. So I look at its weekly chart too. And I look at like the 50-day, 50-week, all the random. I also include the 30, the six week there. It aligns with some other indicators I look at. Right now, like Google had such an amazing run last year. Like that was an unbelievable move.
Unbelievable.
You must have banked in that move.
Yeah, I did okay.
Yeah. So what I would say is, you're at a point right now. I think you're at a point right now, sitting right around that 30-week. There's no margin of safety for this stock at this point. Like if it breaks, because you move so far so fast again, there's not a whole lot of volume below it, like a whole lot of support. It's very easy for it to fill in this vacuum of volume all the way down. I would say down to 204, 205 plus or minus a point or two. And so it's like that. This is a really important level. I'm just looking at that weekly chart. It's elevated. And this is kind of hanging there in the wind right now, kind of like one of your, W pennants in the background. But it's
Like
if it doesn't hold this and move back up towards 350, then there's not a very good margin of safety on that.
Because again, this year, and it lasts, by the way, my 2025, my biggest stock position was Google. My biggest overall positions were gold and silver. So yeah, it was a pretty damn good year.
Great year.
Yeah. But anyway, so I have been making an income position lately, but I might put some put overlay on that too. Bobby?
I would protect it. I would protect that thing.
Yeah, I don't want to give them any of the capital gains tax money, but I'll protect it for sure. Bob?
Yeah. So I want to switch it up a little bit. One of the things that bothers me about the market overall, and I am bullish once we're past this Iran thing. But as people who watch the show know, for me, I'd rather buy things that are moving up. I don't want to try and bottom fish for things. I like to see something that has already made a bottom. That bottom is holding, and then I'll join the ride back up. That's the way I always look at it. But from a perspective of the overall market, as we started to look at the markets and say, okay, there probably is some risk here. This is myself and Mike looking at some of the stocks. Mike Arnold, our partner in the newsletter, starting to look to make some picks in the newsletter. I said, let's look at some defensive stocks. Is Caterpillar a defensive stock with a P of 42?
No, I would not.
Is McDonald's a defensive stock with a P of 30? And what made me want to ask you this question is that even with the weakness we've had, Caterpillar's their P is 38 now. McDonald's is 25.75. So we started looking at things and it worked, like PayPal, which is 8, or like Target, which is 14. So we're starting to look at these stocks that have what I would call depressed valuations for the companies that they are. Like I think PayPal is a takeover target. I think Target is Target, and it's going to be here for a while. And if it's gone, someone's going to buy up the Target name and the Target, and they're nowhere near bankruptcy. So what do you think about that kind of approach right now? It certainly is a different approach than looking at tech, right?
Yeah, Target definitely is one that's moving more than PayPal. PayPal's had that earning. Well, it wasn't an earnings move that it?
No, it was a buyout rumor.
Oh, okay. And then but back there on February the 3rd. So that's probably the day you're talking about there. Like,
yeah.
And then it recovered pretty nicely there on the 23rd and the 24th, but it's still like it can't get going from there. So Target's a little bit better trending move if you're looking to like take advantage of relative strength. I mean, Target's run down to the 50-day. There's an opportunity for it to bounce off that 50-day moving average. So that I would say that's probably a better momentum type trade right now if you're looking for that relative to PayPal, if it can break, again, it's like you've got these highs from post expiration in February. It's right around 48. If you get above that 48, then there's a really good room to run. But it's just really coiling. It's compressed after that.
Well, looking at the PayPal weekly, I don't own it, but I kind of look like I do bottom fish if I'm talking about buying PayPal. But how do you if you're somebody who's active or you're sort of self-directing your own investments, is the only way to get defensive now to kind of follow Jimmy's lead and go into options?
Oh, options for sure. Yeah, for sure. Yeah, you should be taking advantage of those trades. I wouldn't, because I've gotten this question too, because I'm to that point, like we're showing a lot of signs, like I said, that this could turn into a correction, an extended run. There's a lot of technical signs that are suggesting that because we've been so compressed for multiple months. So I have a lot of clients that are like, so then should I start dialing back my portfolios? Should I be dialing back the risk? And it's like, no, because we don't know. Like there's far more moves to the 200-day than that bounce than moves that ultimately break. Far more. And this could very well be one of those. And you don't want to, you have to anticipate that we're going to bounce, because even, bounces off the 200-day, even the ones that fail bounce first and then fail. Like you have an opportunity to watch to see if the bounce fails. And so I wouldn't reallocate and start dialing back risk. I would definitely protect what you got here. But I think there is a good opportunity, to that from right now, again, seasonally, this is a very good time of year. very, very good time. From now until like July, the markets on average do pretty darn well. I know there's the sell in May and go away, but that's kind of myth, right?
So let me ask you then a broader question about PEs. Do they adjust? And I'll give you an example by using the gold silver ratio. So if you go back to like the 70s, the gold silver ratio, the mean was about 34, 35, right? And then you get to, I don't know, 1999 through about 2013, and it was about 61. Then you go from about 2020 to about 2025, and it was 83. And now it's back down into the 60s. Does the valuations, do they also like shift where the mean would be? And I don't mean necessarily just from a statistical perspective. Like, would you say that something like Caterpillar, okay, if they get back down to 5, they're actually defensive. I'm sorry, 25, they're actually defensive again.
I'll take it at 5.
Yeah, 5, I'll take it. But you know what I mean? Do these things shift?
Yeah. I mean, so are investors willing to invest in higher PEs? Like, is the sentiment towards higher PEs, does that change? And yeah, I do. I definitely do. I definitely think that as secular cycles get more and more mature, that people are willing to invest in higher and higher PEs. That's just the nature. That's the nature. I mean, you almost can't invest unless you shift your sentiment. So yeah, I totally think that. But that's what bear markets are for, right? Bear markets are healthy. Bear markets readjust that back to the norm.
I like that. I like that viewpoint as well. So so you guys, you both talked about Target. And Bobby, you remember a year ago, maybe even more, I wrote about it in the Unfiltered Investor newsletter about, the pushback against woke policies and Target, Disney, Bud, all got, by the way, and you guys laugh, but I believe that this was real. I'm just trying to find where the theme is.
Well, so American Eagle.
Yeah, American, right, exactly. Yeah. So
I'm just laughing at how funny it was. Not that you.
Yeah.
Okay, good. Yeah, because people look at me like, "Oh, is it you're political?" No. I'm telling you, look at those charts. Right, it was real. So then you look at Target. Do you think Target has to like come up with an ad campaign that brings back the average guy who said "Go to hell" with your woke bullshit, or not? Do you guys, Bobby? I'll start with you with that question, or is it just a question of P&E? They're still making money.
No, Target took a hit because of that. American Eagle took a hit because of it. Anheuser-Busch took a hit because of it.
By the way, I was trying to fuel that hit, people. Too.
I know you were. I know.
Kowtowing to the administration was such bullshit. Anyway,
and what's funny is like you didn't call for a boycott, which I appreciate. You just said this is dumb.
Yeah.
And there were a lot of people like I think those kinds of things. I don't know if you agree, David, but those kinds of things are more effective on their own. Where somebody walks in, they're like, trans kid clothes in the beginning front of the store. Okay, I'm going to go somewhere else. I'm going to just walk out because those things are more realistic. It's funny to me that anyone actually says we're going to put pressure on these companies to represent what we believe. I go all the way back to Gillette. There's not a Gillette product in my house and there never will be again because they told me what kind of a man, like I could be a better man.
Yeah, I wasn't looking for that. Man? Right.
I mean, I
wasn't looking for that. Thanks though.
But yeah, no, I'm just saying that like from that perspective, as soon as they did that, I'm like, I'm done with you guys. I don't care. You could come back and change your minds and all this because companies are not moral. They're companies.
Yeah.
They sell their products. And when they shift into this sort of virtue signaling morality, I don't have any interest in the company. Having said that, Target just kind of like let it die. Right. They moved all that stuff out. Some of the blue-haired people, I should say pink-haired because blue-haired implies old. Some of the pink-haired people complain that they moved the stuff. They kowtowed to the right. They didn't kowtow to the right. They kowtowed to the customer. And they moved all that stuff away and they're starting to build up sales again. They're really starting to. I mean, you look at their last earnings numbers. They were fantastic. And we have that. It's one of our only longer-term positions in the newsletter. And, I argued with Mike about this. I'm like, that's not really what we do because David, for your information, my average hold time on a stock trade is about 26 days. But this particular one, we're looking at probably playing out over months and months on this particular trade. So yes, I do agree that that's a real thing. I just like the way the right does it more than the left, where they're like, this is stupid. I'm not going anymore. You guys do what you want.
Yeah. And David, before you respond to that, I want to tell you, I own a bar in Chicago, Brant's Palatine. The day that Bud Light decided to go on that ad campaign, Bud Light went from our single biggest in a bottle product that we sold to almost nothing, and it's never ever recovered, not one bit at all. Yeah.
Wow.
So it's just, and by the way, there was never a word said of it at the bar, which is great. My bar is definitely, it reminds you of a Wisconsin Roadhouse. It's a conservative sort of spot. Nobody said a word. Nobody gave anyone a hard time. Just people came and said, you know what? I'll have Coors Light. And by the way, my thesis there was that Bud Light was just an okay product to begin with. You know what I mean? It's not like the NFL. The NFL can mess around and we still keep watching because there is no alternative. Bud Light, there's huge alternatives to Bud Light. But anyway, can you comment on any of this and how you're supposed to take advantage of it?
Yeah, I mean, the idea is like it's all about just generating cash. I mean, these companies, they're in the business of generating cash and earnings. And if anything derails that, Target's a good example. Now, Target was struggling before that, right? It has been below its 200-week moving average for multiple years. So, it would be in a bear market, right? That would be my definition. It's been in the bear market, and that just made it worse. When that happened, it just pushed it down ultimately to its washout low. But I definitely think that it's past that washout low and does have more opportunity. I mean, if you get back above the 200-week moving average, then you're looking, I mean, you should very well have a months-long time frame because it will be months of moving to the upside. That's what happens when markets, or in this case, an individual stock comes off of a bear market low point. That was a nice little washout you had in early 2025 when the market itself was in a correction. A nice little, you retested it again here later in October of last year. You've gone, you've come off of that. You've come up to higher highs. Like there's a very good opportunity here. Now it'll be slow going, but there's a very good longer term opportunity on Target.
Wow.
And
this has been such a value add
stuff, then it's okay.
Really,
this is such a value add for me because I actually believe the Target chart is going up on my permanent charts for the next couple of weeks because I want to be in it because I think it's a good story. I always thought it really had a place if it didn't mess everything up with all that stupid bullshit. And it might.
And I mean, like the net margins, for example, were in a decline since Q1 of 2025, and they turned around. They were up 3.4% in the last quarter. And again, you're talking about a very well capitalized company with a PE ratio of about 14.2. And again, that's low by any. What's that?
Didn't they say something about moving? Was there, or did I just see a rumor about them moving?
I was just about to ask you guys that. Are they going to stay in Minneapolis? Seems like an awful place to be.
No, I did hear rumors that they're going to move, and that would actually, I think that would be as symbolic as anything else. There were a lot of another problem the stock had. There were a lot of closures of stores, and a lot of them had to do with looting and crime.
Yeah,
what they call it, and they were one of the companies that wouldn't call it theft.
Right.
God, it was such bullshit. When they closed in Chicago, remember, they were getting the shit beat out of them all the time. Windows broken, and Lori Lightfoot was like, oh, "I can't believe they're leaving the city. Are you crazy? They literally pay you to protect them, and you didn't protect them. You know what I mean? What do you want them to do?"
They're still down 56.8% from their all-time high.
By the way, that's called karma. You guys were being stupid and you got punished. I'm rooting for you now, but I wasn't rooting for you then. Let's hit a couple more themes before we call it. Bobby, what do you got?
I got, actually, this will go to you first, Jim, and then I'd like David to comment on this because this is much your specialty. What are rates telling you right now? And that comes in the context of we had a big jump in rates from the 19th to the 20th.
Right.
For example, the 2-year rose, I think, 9 basis points. But then we had down 5, up 7, and now down 1 or 2 today.
Yeah.
Contrast that with the 10-year, okay, which also rose between the 19th and the 20th. I think it was somewhere in the range of like 12 or 14 basis points. But then it went down 5, up 6, down 7. Right. So they're falling more on the long end and the short end. What's that tell you? So
we've fallen from what did we close at today? Like 4.32 or something?
Yeah, 4.32.
4.32. So our high was 4.44. See, everybody was saying when the bomb started dropping and 10-year yields went higher, which, by the way, that is somewhat historic. Now, the people who are not panicky were saying, oh, it's just about inflation expectations going further. Inflation expectations going 10 years out from a war that's going to last a month? No, that's not what it was about. What it was about is the worry that we spend too much damn money. And the fact that we're going to have to roll over $10 trillion of debt just to refinance it and then add another $2 trillion of that with new deficit spending means that the market is definitely worried about the bond market. Now, that being said, the fact that it's gone from 4.44 to 4.32 is nice to me. You said before, Bobby, that you want to see crude and the distillates and the supply go back to where it was before you think the stock market can resume its rally. I want to see the 10-year go back below 415 and stay in there comfortably, which I still think is high, but I think it's the market saying, okay, there's no panic. We're not worried about the bonds, because I thought that move higher in yields and lower in prices was a bigger deal than people thought. David, what do you think of that?
I totally agree. Totally agree. I mean, this is far more important to me than crude oil is.
Okay.
Obviously, they're linked.
They're all, obviously in the same link. It's funny, Bobby, is that everybody goes to what their specialty is for what they're saying, which, by the way, I think our specialties, I think our signals are the same, because it'll be the time when crude is higher, when yields go down. But I think we need to see those things happen first.
I mean, you look at like the Japanese yen, it almost trades 1-for-1 negative correlated to crude the last week or two.
Really?
Yeah. So there's a shift in things, as David was just saying.
Yeah. Do you want to call it or anything else, Bob?
Well, I want David to finish his thought about that.
I was going to say, once that subsides, and I do think it will. I don't think we're in a protracted Iraq war type scenario. I think this will subside. That's the nature. It's the MO of the current administration. Whether you agree with it or not, the MO of the current administration is to shake things up and then settle it back down. And that's the end. Until we see something different, then here we've shaken things up. The crude oil's jumped to 100. It's probably not going to get above 100, and yields jumped up to 4.5 almost. And they're probably going to settle back. I expect them to settle back down below that 4.25, 4.15% level. And then, I think that's where the market takes its cue.
Okay, so tomorrow, Illinois plays Houston at 9 p.m. Central Time.
In Houston, by the way, what the hell is that?
In Houston. The whole thing seems like a scam to me. Have you watched Illinois much, David, and what do you think our chances are?
I like your guard. I like the Wagler kid.
Yeah, he's a nice player, isn't he?
I like the big Serbian twins or whoever the hell they are.
By the way, the better Serbian twin is the one that only plays 19 minutes a game. Big Z, did you see that exchange where he blocked the dunk on one end and then did the thunder dunk on the other end? A huge momentum shift in the last game. I don't know what the line is. If any of you guys watching know the line, my guess is we're going to be about a 5-point dog because it's Houston and because it's in Houston. Do you think we'll be more than that, David?
I would go less, because Houston doesn't score. Like Houston doesn't, like, that's not their thing. But they will beat you up. If Illinois can withstand that, just being beat up, then they should be able to score more.
Yeah.
Than Houston.
So who's your team? Who comes out of this whole thing and wins the championship?
I like Arizona.
I haven't watched them as much because they're West Coast. You've probably seen them more than I have. Yeah. Bobby, do you have a thought, or do you feel that being somewhat less of a crazed about it than we are? Yeah, I'm just not to dog you. You got
My thought is this: I think the NFL writing "Stop Hate" on their helmets have stopped hate.
I think so too. They stopped hate.
No, there's no more hate.
I have no hate anymore because of the NFL.
I will say it's nice. As a kid who watched college basketball in the 80s, right? It's nice to see the Fighting Illini back. They had the little run with Aaron Williams, but it's nice to see. I mean, I used to watch. I remember like a Syracuse Illinois, matchup from back in the 80s.
They were a consistent powerhouse back in the day.
Illinois, in a 15-year period, 3 times Illinois got the #1 recruit in the country. Back from it was Bruce Douglas, Marcus Liberty, and who's the guy who died on Michigan Avenue, Bobby, he got
Ben
shot.
Wilson?
Ben Wilson, right. Ben Wilson was the #1 recruit in the country, never played at all. But that was the recruiting power that they had. So again, they're close to being one of the blue bloods if you go back 100 years.
Yeah, you're right by Chicago. How can you not? How can you not get that?
Well, we started losing the good recruits to Duke. It started with it started 15 years ago. Ryan Boatwright went to Connecticut and then won a championship. Then it was Anthony Davis, Okafor, Jabari Parker. We had the #1 players in the country in Chicago like every other year for 15 years, and none of them went to Illinois. John Shire, Doug Collins' kid. It was really frustrating. But anyway,
I think it started with Isaiah Thomas personally, but go ahead.
well, then going to Indiana is not as big a you know, yeah. By the way, like we around here, you know, Isaiah went to grade school, Resurrection grade school, and like I knew who he was. My brother played against him in 7th and 8th grade, and we used to tell Isaiah stories before he even went to St. Joe's for high school. So it was pretty amazing. He was the deal. Okay, I gotta go.
Widge, I see your comment, Widge. We ran out of time. We were talking basketball, so I can't.
Widge, you're still our favorite. So I'll get to your comment on Twitter. So yeah. But anyway, thank you guys very much. I'm Jim Iuorio. That's Bob Iaccino. That is David Settle, who is co-founder of what's it called again? Market
Scholars.
Market Scholars. I'm so sorry, totally sorry that I blanked that out. Again, I couldn't remember what the name of the show was when we started. Okay. Right. But anyway, thank you guys for joining us. And please join the two of us, Bobby, with Mike Arnold at unfilteredinvestor.com. This has been Tradiers, the Trader's Edge. Thank you for joining us.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.